I'm Olivia Voznenko.
I'm Steve Guilfoyle. This is Street Smarts.
Whoop whoop. Steven, I thought the next time we were going to see a bunch of countries fight against each other was the World Cup. But clearly that's not the case. We have tariffs to worry about now.
Yeah, we sure do. Is the World Cup now?
It's in June.
Oh, okay.
Which is like tomorrow. But no, I think it's in 2 weeks.
And that's
June
another
14th.
Italian screw-up, right?
I'm not saying anything there.
Well, anyway.
Shut up your face, okay?
Earlier this week, I wrote an article. I said the short weeks are always long, right? And this week has been nothing but a mess.
Oh, man. Well said, Steven.
I mean, between the whole European banking mess, the whole Italian debt occurrences of Tuesday, coupled in with Spain. Then yesterday, the situation's alleviated. Yesterday, the markets come roaring back. The banks come roaring back. Then today, these tariffs, and the market's right back in the hole.
Is it because we didn't expect some people to not be involved, like Canada and who else?
Mexico.
Mexico, them.
We certainly didn't expect Mexico and Canada. I didn't anyway expect Mexico and Canada to be part of this round of tariffs anyway. I did expect that the EU, based on what we were reading, would be included. And it's, hey, we're not getting what we want. The president isn't getting his agenda through in these NAFTA negotiations. So you know what? He's probably decided to try to cause a little pain, to up the ante as far as negotiations go. I mean, negotiations can still go forward. We can still adjust. The situation is still fluid.
Can they take it back?
They can always take it back. If you have noticed, this president is not an ideologue. He is a populist, which means he can always and probably will always change his mind.
So is that why we saw some crazy stuff going in the treasuries too, right?
Well,
is it because people were entering U.S. treasuries because of it to leave?
Partially,
What's that like better than it exit?
There certainly was a flight to safety, but there's so much going on in the U.S. Treasury market right now. We have no problem with economic growth. With the numbers that have come out this week, the Atlanta Fed just jacked their expectation.
Oh my God, they made it up to, what was it?
4.7%.
4.7%? Oh my stars, Atlanta. I mean, seriously.
That was all the way from 4%. And that was basically on inventory building, net exports, which is a baby of the president, and real consumer spending based on this morning's numbers.
No, those were solid numbers.
They were very solid, except for the inflation numbers. Core PCE wasn't so hot. It came in a little below expectations this morning. So you're seeing a little bit of a conundrum there, and the yield spread, the spread is collapsing between a 2 and a 10-year.
So let me ask you, have you been trading the banks this week?
Actually, I have. Funny you would ask.
Funny we would ask. So this is
Market Rush.
It's time for
Market Rush. During Tuesday's Puke-a-thon, I jumped into JP Morgan and Goldman Sachs at the lows. And at yesterday's highs, it was really tempting to go ahead and take those profits, those short-term profits. But I have greater reasons for wanting to be long the banks going into June, so I didn't do that. In fact, I'm looking at today's sell-off as another potential chance to buy a few of these shares, and I probably will once we go off the air.
Really?
Really. Now, I want to show the folks here what I'm looking at in JP Morgan.
Oh, wait, let me pull up the chart.
Pull up the chart in JP Morgan. And what I see here is a confluence of indicators that are giving us the buy signal. All right?
Is this your like triple confirmation thing?
This is actually more like a quadruple confirmation. If you look at the blue lines, the Fibonacci levels, all right, we have support here right about where the lows were on Tuesday and probably where we're headed today if we see any more selling. You also have the central trend line, which is the orange pitchfork model. Same spot, and the 200-day, the red line, the 200-day simple moving average, all three of those crashed into each other at the same spot this week.
Right there.
Right at the lows, that's right. And you also have the RSI, the Relative Strength Index, which you can see when it bounces off 30, it's pretty much time to buy JP Morgan. Every time this year, and even going back into last year, that it has approached that level, it's been time to buy. So you have four indicators that all kind of jumped in together and made this the right time to buy JP Morgan, at least from my perspective. All right, going forward for the banks, Congress just passed Dodd-Frank. Right? Well, they didn't pass Dodd-Frank. They eased Dodd-Frank regulations.
Are you talking about the Volcker rule?
Right. So that makes, the Volcker rule I'm going to speak about in a second, but what Congress did was make it easier for the smaller banks, the regional banks, to to free up some of these cash flows so they get involved in some mergers and some acquisitions. The
Mm-hmm.
Volcker rule, which is probably going to be eased but isn't quite there yet, it allows the bigger firms to trade on a proprietary basis a little more than they have been doing. You also have CCAR, the Fed stress test results will come out in June. So you have 3 reasons to get on board with the banks, which is why I'm inventory building in JP Morgan and Goldman, for that matter.
Well, you know the banks, but I know fashion. So we did have a request from Allison.
Allison in Maryland, yes.
Yes, Allison in Maryland wanted to talk about ANF, which they're reporting tomorrow.
In the morning, you'll see numbers from Abercrombie Fitch, right?
Abercrombie and Fitch. Before we get to the charts, it's an interesting company. They were so in style back when the preppy thing was just.
What was that? The late 90s,
the late 90s, early 2000s. Now, their edge is that that's never going to go out of style, right? People still go there for their staples. But that's basically just what it is. They tried to reinvent themselves. They did catch some customers with their jeans. They're very trendy with them. But the quality went down along with their prices.
Really?
It did.
I don't wear them. I don't really know.
And so that lost them. Another thing is, everyone I asked on their list, they rather go to something like Urban Outfitters.
Really?
Yes, from like 10 years old to however, infinity.
You know what drove me away from Abercrombie & Fitch? Because I used to go there about once a year around Christmas time and buy gift cards. Mm-hmm. The music was so loud there that I couldn't even wait online.
And they were spraying Fierce on everything. You'd walk in, you'd be like,
it was awful. I'd be online like, oh, I can't wait to get out of here. Mm-hmm. And I was only there for other people.
Plus, another thing that has not changed about Abercrombie & Fitch, their workers, even their management team, they're not happy working there.
Really?
They
always look like a bunch of models.
Well, because they're happy about themselves, but they're too busy being into themselves and helping a customer.
Well, have you looked at the charts of the fundies?
Oh yeah, I did look at the fundies and
Well, I don't think they're that bad. I mean, I was a little surprised. It's overpriced in my opinion.
That's what I was talking about.
All right,
yes.
let's take a look at the Abercrombie & Fitch chart.
It is the chart. The chart itself is bullish. As far right, wouldn't you say? It is a little overextended.
Well, yeah, as long as it catches support on the first fan line. Those are the orange lines on your screen, folks. All right, now it's trading off a little bit. Last LIC is 23.90 today. The forward PE ratio is 26 times, though, which is expensive. When you look at other apparel retailers such as Macy's and Kohl's, which aren't the same kind of retailer, but they're trading around 10, 11 times earnings. So this is an overpriced stock, in my opinion. But they do have a business.
And the thing is, they are approaching their resistance line, which would make a double top. That could be not a good sign.
Right. I do think if you get support on this number in the morning, you probably could look for prices up around 30. But the 22 level, which the stock is much closer to, is a potential point of breakage. The stock could break there and go a lot lower. But I mean, from a fundamental point of view, this firm has more than twice the cash of that level than and that really surprised me because most retailers don't go anywhere near that, especially through what they've been through. Mm-hmm. And they have a strong international business, up 20% year over year, according to the last quarter.
Next time I want to cover Urban Outfitters, because like I said, a lot of my friends were shopping now at Urban Outfitters rather than Abercrombie & Fitch. They have much better fundamentals, but can we get into that another time?
Yeah, sure.
All right, let's get into another request we had.
Oh, boy.
This was via Twitter.
This is for Diane in Dallas.
Diane in Dallas.
Who is interested in Mattel.
Mattel.
I missed.
Mattel. It's okay, Stephen. No one saw. Kobe, not. But okay, Mattel. Does Barbie play basketball?
Barbie, Hot Wheels. I mean, Mattel's got some issues. All right, they got a lot of issues. All right, they're also an expensive stock. They trade 35 times.
Let's pull this chart up for our viewers.
Go right ahead.
All right, here we go.
All right, you can see on the chart that we have both a declining trend and an upward trend about to meet very shortly. And although we've seen some positive money flow, I think it's more likely that you'll see a real test at 14 3/4 more shortly than you will see a break. Right here at this level, which is a pivot point, is around 15.5. It either goes to 16.30 or 14 3/4 from here. I think the downside is probably more likely, given what I see in the fundamentals, which is a negative operating margin, a negative 3-year sales growth, negative cash flow. Even operating cash flow before you take out expenses, still negative. This stock is a stock with a myriad of problems, and I got to read this piece to you because this is really the icing on the cake. All right, what they did was they announced.
What did they do, Stephen?
About a week ago, they announced an offering of $500 million of 6 3/4 senior notes due in 2025. And they're going to use the proceeds of that to redeem and retire all of their 2.35% senior notes that are due in 2019. That deal closes today, by the way. So what they're doing is pushing out their debt because they really can't pay off the debt because they have negative cash flow.
Right, but their quick ratios.
Their quick ratio is fine. It's still 1.2. They're not about to go out of business, not running out of money. But Toys R Us not existing in the future is a real problem for these guys and for Hasbro, but Hasbro's a much more solid company.
On top of that, Stephen, they've had 5 CEOs in the past 5 years.
Right. I mean,
I'm serious.
Well, that's like
one.
That's worse than the Knicks.
So, the newest one is in May. I don't know the name off the top of my head, but maybe they can, bring some positive returns for Mattel.
Not if somebody doesn't try to save at least part of the Toys R Us existence. I don't think people are going to buy toys off Amazon or from Walmart in the same way that they used to go to Toys R Us.
I go to the local toy store. I got my Barbie pet rescue. I guess they need a Barbie stock rescue.
I don't have a Barbie pet rescue.
Oh my God. Well, you need to get one. Anyway, just like Barbie buys her friends, I wish we could buy some time. Stephen, do you want to go over NFP real quick?
Well, it is going to impact monetary policy, so you can't not go there on a
All I'm
Jobs
looking
Friday.
at is if unemployment rate stays at 3.9, that's a grand thing.
Well, it's a grand thing. The unemployment rate is kind of garbage anyway. The underemployment rate is 7.8%. That's what I look at as more of the true rate of unemployment.
Very well then.
But I mean, that's still a strong number. We look at participation also. Participation has been 62.8%. Well, it's really huge because it really is the truest measure of how engaged people are and how much confidence they have in being able to find and keep a job.
Okay.
So I think the headline number, which will be somewhere, the expectation is between 185 and 190,000, that will have less of an impact than wage growth. Wage growth is where they're going to go tomorrow. That's what the Fed's going to watch. It was 2.6% last month. We're looking for 2.7% this month. After the disappointing inflation numbers today, that will be in focus.
Yeah, that's going to be a big game changer.
That's where your probabilities trading in the options market, trading in Chicago regarding Fed futures will be.
Well, hopefully for the bulls out there, that gives some positive news going into this weekend.
Is this a bull?
That's a...
I thought it was a rabbit.
And this is a bear. A rabbit, that's like this. All right, well, let's bounce out of here.
Oh, my goodness.
Sound good?
Oh, that sounds great.
Thanks for tuning in, guys. See you next week.